Hello, hello, everybody. So we have Adam. Adam is a professional money manager and a fiduciary. Um, Me and him decided to just geek out over technicals, over trading and charts and how the market moves. Me especially, I do a lot of futures contract trading on the side. It was fun talking with Adam. I got a lot of insights on how a fiduciary would look at the market. So if you're looking at bettering yourself or improving your investing skills, definitely listen in. But also, if you are an accredited investor, definitely give Adam a call. I'm sure he would just love to chat in general about the market. Let's begin.
Welcome to the Josh Bolton Show, where we dive into interesting and inspiring conversations. And now, your host, Josh Bolton.
All right, for sure. I think give us a quick introduction of yourself, who you are, and we'll get right into this.
Sure. So my name is Adam Koch. I am the president, founder, senior financial advisor, and portfolio manager at Libertas Wealth Management Group in Columbus, Ohio. So the Buckeye City. Um, Been in the business for 23 years. I always say I haven't worked a day in my life, at least for 23 years anyway. Those part-time jobs were rough though before then.
Oh, I bet. I bet.
But yeah, we're a financial planning firm first, investment management firm second. But probably what makes us really unique is aside from the full-blown, comprehensive, all-inclusive financial planning, retirement income planning, tax planning, estate planning, insurance planning, all that stuff, and being a fiduciary, a true fee-only fiduciary. The other thing that I think that is probably going to be interesting to those listening or watching is the fact that our portfolio management strategies are all built around technical analysis, relative strength, and things of that nature. So the nerdy stuff that only certain audiences actually care about. So I'm really looking forward to this.
Yeah, no, I enjoy this stuff. So, what specifically did inspired you to become this?
To be a technical analyst or get into the financial advisory services?
Both.
Both? All right, cool. We'll do the long one first, and then, well, I don't know, maybe they're both long. Um, I went to school. I went to college to be a trauma surgeon. This was not my path. I know. There you go. Don't choke on it on your drink there. Um, and is this audio, by the way, or
Yeah.
just any video?
It can be if you want.
Okay, it's up to you. I'm fine with it being video.
Okay.
Totally fine. So yeah, I didn't drink in college at all. I DJ'd and I did plenty of, I had plenty of fun, but I was pretty clean because I competed for Ohio State in Taekwondo, and I was really, really all about keeping my speed and fitness and all that stuff. And I always joke that was about 60 pounds ago at this point. So um, things have changed since then, but I guess that's life in adulthood. But anyway. As if I can make this story as short as possible, I basically did really well when in my sophomore and junior year, and I had these big, huge aspirations of making it to the Pan Am Games. And to make, again, long story short, I broke up with a girlfriend. I was showing off at the gym, trying to do the splits on two chairs like Van Damme, and I tore my hamstring halfway off my pelvic bone and ended my fighting career. Basically, I can look back. It's funny now, but I can look back and say that in retrospect, I was absolutely depressed. Not, I kind of stopped caring about school. Called my dad up one day walking down through campus and said, "Hey, I've decided I'm dropping out of the pre-med program." And he's like, "Well, what are you going to do?" And I'm like, "I don't know. I'm been thinking about it. I've got some ideas," and we exchanged some ideas. And then he goes, "Well, why don't you become a financial advisor?" And I'm thinking, financial advisor? I'm like, "Dad, I took one econ class in college. Like, why in the world do you think I'd be good at that?" And he's like, "Well, you've got that virtual stock exchange account you're messing around with. And it would be a lot like surgery, except financial surgery instead of, physical surgery." So, long again, I want to keep saying long story short and then make the story long, but I basically talked to his financial advisor. I went to a seminar back down in Columbus, so I'm from Cleveland, but went down to Columbus, went to a seminar for a national brokerage firm. Decided to give a shot, fell in love, ended up getting 2 degrees, one in finance, one in psychology. So I always joke that I use the psychology degree more than I do the finance degree half the time.
Seriously.
But yeah, and yeah, so I did really well out of the gate at this national brokerage firm. Even though I was 21, looked like I was 16 at the time. I started 10 days before the World Trade Center went down and was trying to get, people 3 times my age to trust me with their life savings. And it was not easy, as you could probably imagine. So, but I still worked my butt off and, pushed through the rough times and started this company November 4th of 2004, Libertas, that is, Libertas Wealth Management Group. And our website's libertaswealth.com. And basically I kind of, at this point in my career, with it being 23 years in, what gets me really pumped up every day and kind of keeps me really excited and momentum going is saving people from bad advice and bad advisors. So that's kind of like my personal. I haven't been talking about that till maybe recently, but that's something I guess somebody asked me, and so I'm making it a little bit more public. But that's what I think about when I'm in the car in the shower. Is that's what really kind of gets me out of bed in the morning is saving people from the unfortunate fact of the matter is that this industry, there's too many bad apples. So. Anyway, so that's kind of how
Oh,
that started. I've got a couple other companies we can talk about, but maybe today we just kind of stick with the financial advisory, portfolio management, that kind of stuff.
I like that. Yeah. Definitely might have to talk to you another time about those though. So for the technical analysis, are you traditional analysis or you blend a couple of the more modern indicators too?
I would say that first and foremost, to make it easy and simple for those that are beginners and really don't know anything about this stuff, I'm not a fundamentalist, so that's kind of the opposite of a technician. So I don't really spend the only fundamental indicators or metrics that I look at are occasionally I'll glance over at sales and quarter over quarter, year over year sales increases is what I'm looking for, or earnings. I'll look at earnings too. But other than that, the probably the most the biggest things I'm looking at on a day-to-day basis are trend, so price, trend, momentum, and volume. So those four things are the biggest, and then if you put one big all-encompassing thing above them, it'd be relative strength. So I always call relative strength like people say relative strength. What is that? What's that even mean in the investing world? And it's like, well, if you imagine every investment you could possibly invest in was that all the teams in the NFL. It'd be like, or now it's college football playoff season, right? So it's all hundred and some odd teams in the NCAA. It would be like investing our money in the playoff teams and avoiding all the rest. So that's what investing in. That's what relative strength is.
Okay. Yeah. Honestly, I guess I would be more of a hybrid then. So are you familiar with Ken Roberts for
No, I'm
futures
not.
trading?
No, no.
He was a legend in the 90s. So I found him through my mom, essentially. And so he taught me essentially contrarian, but he
Yep.
does that's where I was saying it's like a 1-2, like one top, two bottom, three mid, like the 3 points.
Okay.
So that's where his is like if you see those and if it's a three high, it's going down, three low kind of thing. So that's mostly what I use. And then yeah, I don't use it for the actual trade, but it's the parabolic SAR and the ATR to confirm that it's going down.
Sure. Yeah, yeah. I like. I'm not. I don't use parabolic, or any of the indicators that include the word parabolic, but strength of trend is hugely important. Things like ADX. So yeah.
Yeah, so that's where I use Ken's method to call the top and bottom, and then I use those indicators to prove that I was correct. But it doesn't matter really to me because I always get in like 3 or 4 bars earlier than the actual indicator popping up.
Okay. Nice. Yeah. I mean, I think at the end of the day, the great thing about technical analysis is that it's huge and robust, and there's about when they say there's a few ways to skin a cat in technical analysis, there's probably 200 ways to skin the cat. And
Yes.
the terrible thing about technical analysis is there's 200 ways to skin the cat. I mean, so it's the great thing is the same as the worst thing about it. I mean, you can kind of go down the rabbit hole. I'm sure you see these charts on Twitter, or X as they call it now, where, somebody puts a chart up there, then they have, three moving averages, then they've got diagonal trend lines, then they've got horizontal lines of support and resistance, then they've got a cloud on top of it, they've got volume bars on the side, they've got five indicators below it, and it's like that's not going to help you at all. I mean, that's not going to
No.
do anything for you.
Yeah, unless you understand the structure of what the chart means, all that is just a bunch of distracting overlays.
It is. It might look sexy, but to the
Lay
amateur
person.
eye, but to anybody who knows what they're doing, there is a such thing as a lot being too much.
So for you, especially doing this 23 years and also being a fiduciary, what are some of the strategies like? especially with the last few months with the election fears. How do
Mhm.
you choose to get in and out, especially with this uncertainty in the market right now?
Yeah, I think that's a great question. I think it's important that before I answer it to define, well, to make the point that everybody needs to have their own time frame. So, what I'm going to share is my time frame, and but to define all of them, not all of them, but most of them, the main ones anyway. The first is ultra short term like day trading. These are where
Hmm.
people literally go to cash every day at the close. That would be one time frame. Another time frame is called swing trading. Swing trading, you're owning positions for maybe a few days up to 3 weeks. One of the best swing traders in the country, in my opinion, has been my friend Brian Shannon over at alphatrends.net. He's amazing. So if you're looking for help with swing trading, go check him out. Subscribe to his service. But I don't get anything for it, by the way. This is just selfless acts of
Right.
kindness here. The next time frame would be short term, which is I'd say a month, month to 2 months, call it month to 3 months. The next would be intermediate term, which is like 6 to 12 months, and the last is long term, which is 1 to 3 years. I'm in that intermediate time frame, so I'm kind of trading over a 6 to 12 month horizon, if you will. And so when the election was coming up, my trends that I'm following are a little bit slower than say than a swing trader might use, or even a short term trader. So and the reason I sit where I sit is because I've tested several strategies. The great news is they all work if you follow your rules. I mean, so it's again, this goes back to the whole 200 ways to skin a cat. But the bad news is that when you're in the business of managing money for other people, I think there is a suit there are optics you have to worry about. And what I mean by that is the number one reason why clients or individuals, couples, whatever, investors, financial plans fail is because they abandon their plan. And the number one reason why people abandon their plans is because the portfolio wasn't allocated correctly. It was too risky. The volatility was too high. And so right along those lines, if you have a time frame that is too short, you can get a lot of trading. And then when you get a lot of trading and you're making money, nobody cares. But inevitably, the market's not always going to go up and you're not always going to make money. And that seems obvious to you and I.
Right.
But I mean, the second you start losing money and you're placing a lot of trades, you get that brain trash where the human beings are just terrible investors and they start going, "What are you doing? You're placing all these trades. It doesn't even cost them anything. We pay for the trading costs." But
Right.
they're going, "What are you doing? What's going on? I'm losing money. You're placing all these trades. You're just losing money." And it's like, well, I don't, nobody goes into a trade and goes, "God, I hope this goes down so I can sell it and make a loss." Nobody does that. But there is a such thing as a good loss. And that is having risk management in place, knowing, what your exit strategy is. And when you hit that exit strategy, hitting the button and walking away. So my time frame as the election was coming up, we didn't change a whole lot. I mean, oftentimes the market tells you, well, yeah, the market tells you what to do, not the other way around. So I think that what we were going to see with the election is we were going to see, in my opinion, the market was still going to go up. It didn't matter who got elected.
Right.
I just think the
Yeah.
question was really where was that relative strength? Who are the playoff teams going to be?
Right.
Depending on the president who won. So I think we're already starting to see, small caps are starting to gain traction. That makes a lot of sense. For instance, that's just one example.
Right. Yeah. For me, I was thinking the same thing. It doesn't matter who gets in. The only one I was thinking like with Kamala Harris was really going to tax the unrealized capital gains. I'm like, that's going to be tricky. How
That
do you
wasn't going to
plan for
happen.
that kind of thing? Huh?
That wasn't going to happen. I mean, that was one of the reasons she lost the election. But any advisor to her that has half a brain, once she won, would be like, "Look, you can't do that. That was great. That was a great talking point, to get people, thinking, let's go after the rich and take their money and pay off some of this debt. But if you taxed unrealized cap gains, investment in this country would just absolutely sink like a rock. That would be a terrible idea."
No, and that's kind of what I was thinking too. I'm like, I think it was just a bunch of lip service to get everyone else really all excited, like, oh yeah, Robin Hood, cake from the rich. But I'm like, it's not going to happen. The powers that be would be like, yeah, no, you're not doing that kind of thing.
Exactly.
Or it's like, or you're going to give us a really nice loophole if you are,
Yeah. Well, yeah, that's even worse. Just more complication for the CPAs, right?
right? And you do that too, correct?
We don't do taxes. No, we're at our office we're CFPs, so we're certified financial planners, which basically means that
Mm.
it's the most elite designation in the financial planning world. but it makes us, and basically what it means is we're really dangerous when it comes to things like estate planning, trusts, wills, powers of attorney, charitable planning, taxes, tax planning. But we don't write wills, we don't write trusts, we don't do anybody's taxes. We have a client like once every few years that'll say, "Hey, could you hire a CPA? And I'd love to have everything done at your office." And, twice in the last 23 years, I've surveyed our clients to say, "Hey, would you be interested in that?" And the glaring kind of overall message is no, stay in your lane. So we just stay in our lane.
At least they're honest with you.
True story. Yeah, no, it's good. Best way to get better is to ask the people who hire you, right?
Exactly. Um, so what are some of your strategies when there's a lot of fear and like, let me rephrase that. What is your stop point where it's like at 2% loss or whatever indicator I'm pulling out because it's like I can't afford to take more than this.
Sure. Yeah, in our trend following models, so we have 18 portfolio models we manage, and 8 of them are trend following models. The others don't have stop losses. I would say that they have ranking stops, so it's all relative strength based. So what that means is going back to that playoff team analogy. If a team has a few losses, and they have a losing streak going on, so they're not performing well, a couple losses, even 3 losses, that's not a trend yet. But if the win loss record starts to get to a point where it doesn't make sense, or that team's not going to make the playoffs this year, we want to eject it and buy whatever's at the top of the ranking system. So the strategic models are not meant to go to cash. The tactical models are, so they use that same relative strength, stay invested with the playoff teams, but avoid the rest strategy. But there's also a trend following filter for every position in the portfolio for each of those 8 models. And the one that I use is the 40-week moving average. So whenever there's a close below the 40-week moving average on Friday, I'll typically give it to the European close on Monday, so 11 o'clock on Monday morning Eastern. And
Mhm.
if it can't reclaim that line in the sand, then we're out. And again, so what you got there is, and a strategic portfolio would hold on to that position, but you own essentially the cleanest dirty laundry, right? It might be outperforming the market, but on an absolute basis, it's still dropping in value, which the whole purpose of technical analysis driven portfolios is to, look at risk not as volatility or just standard deviation, but to look at risk more along the lines as loss of principal, drawdowns, right? So
Mhm.
for in all those models, it's very simple. 40-week moving average close on Friday. Again, we give it some time the next week to see if it can reclaim that line in the sand. If it can't, it's out. If it reclaims that line in the sand a few days later and it closes above it on Friday and it's still in the ranking system at the top, then we trade up. We buy it again. That's where you have to be nimble, follow your rules. You can't be mad because, oh, it went up. If I just would have held it, I wouldn't have lost. I would have made more money if I held it. But I've got this crystal ball in my conference room that a client bought it for us as a joke gift. It doesn't work, and anybody can tell you they're a trend predictor is lying, right? I always say we're trend followers, not trend predictors. So anyway, so yeah, that's essentially our most common line in the sand. Which again, every stock, every commodity, every crypto, digital asset, bonds, they all have their own metaphorical line in the sand. So it's not like there's a switch that goes off in the market and then you sell everything in your portfolio. You treat every individual investment as its own.
Speaking on crypto, what is there? Is it a more aggressive strategy or a similar one modified for crypto?
No, well, no, actually. It's funny you asked that question because I'm in the process of potentially building a couple model portfolios aimed at only crypto. Because in my opinion, I think that the crypto asset class is just that. It's going to be a new asset class.
Mhm.
To this point in the industry, there have only been 6 asset classes. There's U.S. stocks, international stocks, currencies, commodities, fixed income, and cash. But now I think there's the 7th asset class. I think people are starting to realize that crypto is probably here to stay. So as that happens, I think that the way to do it, in my opinion, is to first and foremost do a relative strength calculation that ensures that you're buying the right, I'll call it the top ranked or the digital asset with the most momentum. So if first of all you have to look at the relationship between them, let's just say Bitcoin and Ethereum.
Right.
So you want to own the highest relative strength position between the two, let's just say, and then throw a trend following filter on it, like the 40-week moving average. Now, some people might want to go faster than that, and honestly, I don't think there's any problem with that. Like for instance, if you want to use the 10-week moving average instead, and by the way, the 40-week moving average is very similar to the 200-day
Mhm.
mathematically. And so the 10 weeks the same as the 50, like the 50 day. So you could use a faster moving average, and what's going to happen is two things. One, you're going to get in sooner and out sooner. However, and this is the most important lesson here, there are going to be way more whipsaws where you get out soon, so to speak, but as it comes back, you're going to have to pay up to get to, pay a trade up at higher prices because it was just a whipsaw. It wasn't an actual trend change. It was just, call it a severe pullback or a mild correction.
Yeah, I want to say, especially with all the gas fees, if you're trading the straight currency, not the futures contracts, that's going to be you could be losing more on the gas than the actual currency itself.
Yeah, sure.
So that was going to be the next thing I was going to ask. Are you going to do the actual like? Because they have a couple Bitcoin ETFs, futures contracts. Are you going to, or would you consider trading the actual coin itself?
Because of the fact that I live and work in the most highly regulated industry in the entire world, and because I can't even imagine how I would go about setting up an institutional investing company that had a custodian that was a digital wallet that I somehow discretionarily managed digital assets for clients. I don't even know how you would do that. I don't even know if it exists, to be honest. But I'll tell you right
I
now,
honestly, I
if it
don't
did
think there
exist,
is something for that.
I don't think so. And if there was, I would want to do it anyway. So as you mentioned, there's ETFs. GBTC, Grayscale Bitcoin ETF was the first big one that kind of came out. It's got the most history, but it doesn't track really well with the actual underlying digital asset. And then BITO came out, BITO came out. I'm trying to think, when did it start? Let's see here. I'll just pull it up. So yeah, it launched on in October of 2021. So it's been around for 3 years at this point. But there's another one that just launched earlier this year, actually I think it was the second week of the year. It's called the ARK 21 shares Bitcoin ETF. The symbol is ARKB. And what's really cool about it is it tracks the underlying Bitcoin asset pretty well, better than the others, I think. And then B, it's super inexpensive. So like GBTC, BITO, they're pretty expensive ETFs. This is 21 basis points.
Okay. So then the other one was BITO.
BITO, GBTC, and ARKB.
Okay.
But yeah, I think that our strategies are completely exchange traded. We're using ETFs. We're on the broad market. We're not gonna buy a digital asset for a client. That's a mess that I'd even have a hard time explaining.
I was going to say just the regulations for your industry to explain to who the powers of the government, like, why are you doing this? It's like they asked me to,
Yep.
and
Yep.
nothing.
Exactly.
So, is there any particular sector other than like Bitcoin and stuff like that you're looking into
Right now,
for investing? Yeah.
I mean, at the moment, we're I like small caps a lot. Small caps have been underperforming for a long time. I mean, they showed kind of a glimmer of hope in early 24. And but when you look at a chart, if you pull up a chart like of IWM, for instance, the iShares Russell 2000 ETF, it was underwater. You could say it peaked out in like November of 2021, but we're talking, it was like a 1 or 2 week breakout and then it failed. So, I mean, you can go all the way back to say, I don't know, early 2021. So, I mean, we're talking 3.5 years ago. It's been underwater until literally just a couple weeks ago. So you literally, if you invested in small caps back in early 2021, you were a loser still just a few weeks ago. And that's as compared to like the NASDAQ or the S&P, where, S&P broke out a long time ago. I mean, S&P broke out almost a year ago at this point. So you were
Right.
profitable a whole year ahead of time. And I think a lot of that's well, not everything, but a lot of it's had to do with interest rates being high. When interest rates are high, small businesses struggle. I think the election helped out a lot, and is going to help out a lot. I think that the current administration is going to be very small business friendly. I think rates are going to continue going down at the Fed, so I think that's all going to help small caps, and we might see some outperformance there. So in other words, there might be an opportunity to outperform if you have an allocation to, if not an overweight, in the small cap space. So I'd say that's a big place we've been. Some others, I mean, we've been invested for quite a while now in, industrials, technology, AI, things like that. Some individual stocks we've owned for a really long time would be like Nvidia. I don't even know how long ago I bought that thing. It's been a while, but Nvidia, Meta, Broadcom, Netflix, Intuitive Surgical, Costco. So those are some of the stocks we own right now. And I guess I already disclosed it, so I wanted to make sure I disclose. Hey, if I'm talking about this, we own it. So yes, we own it.
And this is not financial advice.
That's right. It's not financial advice. Talk to a qualified financial advisor, ideally a fiduciary, before making any decisions about your portfolio. Anyway, yeah,
Throw that in there for
that's right.
yeah, that's interesting. Yeah, I actually bought into Exxon and Costco like 2, 3 years ago.
Hmm.
I don't know why everyone just hated them. I knew they were making money, so I just bought a couple shares for the fun of it, and that's where I watched it go 100%. And I'm like, oh dang.
Yeah, Costco was definitely a winner there.
Oh
But
yeah.
with energy's really struggling. It's been struggling.
Yeah, that's kind of where I bought in. Gosh, I think I bought in right around the same time with Buffett and I didn't even know it.
Okay.
So I rode Exxon with him, but I got out. Yeah, because it was showing a lot of weakness. It was like 90%,
Yeah.
then it's dropping to 80% profits. And I'm like, it's probably gonna go down, so I'll just cut it and take the money.
Yeah, I'm looking at it right now, trading at $111.95 overnight, and it is literally trading at the exact same spot it was in October of 2022. So 2 years ago, nobody's made any money. Yeah,
Yeah. And that's where like I said, I got in at that point. I wrote it up to like 90%, cut it, and because I'm like, yeah, it's just showing a lot of weakness now.
yeah.
But are there any other sectors like real estate you're looking into, or
No,
stuff like that?
no, I'm not really looking at real estate a whole lot. I mean, real estate kind of looks like small caps did to me maybe a year ago, where again, if you look at real estate on a chart, the peak in real estate was literally the last week of the year in 2021. And as of right, and that was, by the way, that was at $115, $116 a share on the IYR, so on the iShares real estate ETF. And it's traded at 97 right now. So, I mean, it's down, somewhere in the ballpark of, we'll call it 20%, maybe 15, 20% off its, still off its highs. And I think real estate's also, in my book, a relatively defensive sector. So I think it depends on what happens with the market. Interest rates again are going to be a part of that discussion.
Mhm.
But I think when you're in this kind of environment where rates are falling and could help real estate, I think that you also have to look at all the other options that are out there. It's why I believe so strongly in relative strength and so strongly in concentration to a certain extent as opposed to diversification. Because if you just buy some real estate and food and beverage and some cyclicals and some industrials and utilities, and you just buy a little bit of everything, so maybe some commodities, maybe large caps, maybe small caps, eventually you've just built yourself an index. You just own the S&P 500 at a certain point. I mean,
Right.
so I think that it's important to concentrate your holdings in the best asset classes, or if I were to say it another way, you want to concentrate your holdings in the best stocks, if you own stocks, within the best sectors and industry groups within the best asset classes, and stay invested in that way, and then just stick with the momentum, stay with strength. And then when things don't, start to fail and roll over, understand that if you sell the top, you got lucky. That's it. That's all it was luck. Nobody sells
Yeah.
the top. Nobody buys the bottom. So just when it starts to fail on you, stick to your rules, whatever your rules are for exit strategies, walk away and, stick with whatever the next trend is.
Yeah. So then it's a lot of it's relative strength and the trend of it. Okay. Are there, other than the 40-day moving average, what are the indicators for you? Is it like the 14-day moving, 20 to confirm or let's give signal to the trend going up or down?
Sure. I mean, for like, having just looking at a moving average alone, it's important to understand what direction it's going. Like what direction is it sloping? There is the such thing,
Mhm.
by the way, as trendless. It doesn't always have to be an uptrend or a downtrend. It can be trendless. It can be choppy. So that would be one. I look at RSI. So primary, like everybody who looks at RSI usually looks at RSI 14. So 14 period RSI, I look at that quite a bit look for divergences. I'm looking for instance, when the market's going up, well, and all the time with investments we own, with the market as a whole, when it's doing well, I'm looking for reasons it's going to turn over. I'm looking for problems constantly. And when the market's going down, I'm constantly looking for positive evidence. So I think one of the biggest mistakes that investors make if they're managing their own portfolios is when things are going well, they get so euphoric they don't spend as much time, like they're enjoying it too much. Where if you're going to manage money, you can't enjoy it. It can't be something that's fun. Fun is like going to Vegas.
Mm.
Managing your money has to be a very, very serious undertaking. So like I said, when the market's going up, like the stock market's been going up now for 2 years, I am always trying to find reasons that there would be positive evidence, or I'm sorry, negative evidence on the horizon. Um, so like a negative divergence in RSI would look like higher highs in the S&P, but then lower highs in RSI. Another example might be if I'm looking at something really, really short term. So I'm looking for a short term entry or exit. I would look at RSI 5. It's much faster. It gives you quicker information, but you got to understand you're looking at a much, much shorter time frame then. I look at it's similar to RSI, but MACD. Whether you're looking at the highs and lows for a divergence there, or if you're looking at the histogram. That's another, the histogram is obviously the difference between the signal line and the moving average. And so you can use that for divergences as well, which will give you a hint of either good things to come if the market's going down or the stock's going down, or bad things to come if it's going up and you see a negative divergence there. When I look at the market overall, I like looking at breadth indicators. So percentage of stocks above the 200-day, percentage of stocks above the 50-day, new 6-month lows, new 6-month highs, new 12-month highs, new 12-month lows. And I'm looking for, signs of weakness or strength for that matter when the market's going down, weakness when it's going up. So because most people don't know this, and a person who taught me unfortunately passed away. I'm looking at a picture of him on the wall over here. Oh my God, I'm going to stroke out here. Come on, Adam. I am stroking out. Hold on.
It's okay. I call
We're
it
gonna have
like
to
the runaway train.
we're gonna have to cut this and go back.
Okay.
It's been a long day. I started at 7:30 with an interview with a potential employee, and then here it is. It's almost 7:30 right now. Former president of Lowry Research, Paul Desmond. I didn't even have to wait for it to find it to pop up. I just knew it was Paul. Anyway, Paul Desmond. So if I start over and we cut in here. One of my one of my mentors over the years was Paul Desmond, who was the former president of Lowry Research. He's since passed, and Paul was the person who taught me early on that the way markets crash is like this: small caps crash first. So what you have is the big smart money selling the small caps and trading up into mid and large caps and mega caps. So then they sell their mid caps and they'll start to head downward and you do selling pressure. Then they start selling their large caps, and the reason markets crash this way, and the reason it's such a or such a I call it a secret in the business, is because most people don't know that all the major market indices that people watch every day, that see on TV, on the radio, are cap weighted. So the Dow is 30 large cap stocks. There's no small caps in it. So if small caps and mid caps start to go down, you won't see it because there's no small caps in the index. If you're looking at the S&P, which is what probably most people look at, the S&P 500, it's 502, 503 stocks, and it's cap weighted, which means when Microsoft has a big day or when Apple has a big day, the S&P has a big day.
Right.
So when you start to see small caps failing, they have such a low representation on the S&P 500, it won't even put a dent in the index. Same thing with mid caps. Then when the smart money says, "All right, that's it, I'm done," and they start selling their large caps or stop buying large caps for that matter, now you see the market start to roll over. And that's exactly what happened between 2021 and 2022 is small caps started to fail in February, then mid caps, and then you had, kind of like the hairpin on the top of the pile that caused the avalanche, which started in November, December.
Would the VIX and the value line gauge geometric also be able to help gauge that too?
I
Or
think the value line's interesting. I look at it at least once a quarter. I don't use it as a main tool in my trading decisions, but the value line's good for knowing kind of what the average stock is doing. And the VIX, I think it's good to know if the VIX is trending down. That's obviously a good thing. I do. There's a good friend of mine, Andrew Thrasher, has won a couple awards at
Mhm.
the Chartered Market Technicians, the Dow Award for technical analysis on VIX studies specifically. And I think when you start to get long periods of weakness, or which is good, right, in the VIX, you're that much closer to a VIX spike, which obviously would cause a pullback or a correction. So I think that I probably use the VIX a whole lot more when the market's in chaos rather than when the market's doing well. And I use Andrew's volatility risk trigger, the VRT, as just kind of like to see when that's going to happen, because I think it gives a sign that you might see a volatility spike, say in the next 1 to 3 weeks or so. But yeah, I definitely look at the VIX.
Okay. Yeah, for me, kind of like you, it is not the heaviest weight in my analysis of everything, but it's kind of like more of a pulse. It's like, everyone's really greedy right now, so better weight on buying stuff kind of thing.
Yeah, that makes sense.
Yeah, cool. Is there so is for you keep mentioning the small caps, is there a specific index that you look at, like the Russell 2000 or something?
Yep, it'd be the Russell 2000. I mean, I'd be looking at for somebody who wants to get a pure play on the small caps, it would be IWM. If you're looking for something a little bit more diversified that gives you exposure, but keeps you in some large caps, then I would look at like RSP, which is the equal weighted S&P 500. So after I just got done sharing that the S&P is a cap weighted index and that there's the small caps get no representation, the
There is one now.
RSP is the equal weighted index. So instead of having all the large caps get the weight, every stock in the index then gets an equal weight. So it's equal representation.
Okay. That's a good one. I didn't know that, so I'll definitely look that one up.
Yeah. The good analogy is we're talking about politics, right?
Hmm.
Every when you look at Congress across the country, every state has a different number of congressmen or congresswomen, depending on the size of the state, right?
Hmm.
That's like the S&P cap weighted index or the Nasdaq. The equal weight is like the Senate. Every state gets two. That's it.
Okay. So yeah, like if you're, I don't know, some microchip company has like 8 or 10% of the weight, it would just make it like everyone gets like a 1% representation kind of thing.
Correct. Yep.
Perfect. No, that would make more sense. Yeah, if you have winners that can move the whole index, they can also drop the whole index kind of thing.
Yep. You got that right.
Cool. Nice. Yeah, I'll definitely look that up. Is there anything in particular I might have glanced over or missed that you want to talk about?
Maybe it's just a final note. I'll just say it's not going to be all that. I'm going to warn you, it's not going to be all that exciting. But I think that one of the biggest mistakes people can make is that if they're investing and it's really exciting, they're probably doing it wrong. But with that being said, um, all this stuff's great. It's fun. It's interesting, right? Technical analysis, I love it. I mean, I live and breathe charts all the time, but at the end of the day, none of it matters if you don't have a plan. So I think it's above all this investing stuff that we talk about and how much fun it might be, how interesting it might be. If you don't have a full blown comprehensive financial plan in place that tells you how much you need to be saving and what types of accounts to get you to retirement on time so that you can make work optional someday, then you're essentially driving you know, through a cornfield in reverse at night, looking at the rearview mirror, trying to figure out what your path is, and that's probably not exactly the best plan in the world. So my best advice is obviously honestly not all that technical. I mean, I could talk about technical analysis and charts and trend following and relative strength all day long. I love this stuff, but it doesn't mean anything without a path there. It's like an engine without wheels, you got an engine going, but you need wheels to get you to where you're going. And of course, if somebody says, hey Josh, I want to go on the best vacation of my life. It's my 40th birthday, and I want it to be huge. And I want you to help me get there. What's the best way to get there? Where should I stay? How should I fly there? What are the best places to eat, things to do? And you're like, all right, well, cool. I'm down. Where do you want to go? And you're like, well, I'm not going to tell you that. So how in the world am I supposed to let you know? How are you supposed to help me find my favorite best vacation in the world if I'm not going to tell you where I even want to go? It'd be like
Right.
going to the doctor's office and saying, I am in the worst pain of my life, and I'm fearing for my life right now. And he's like, well, where's it hurt? And you're like, I'm not going to tell you.
Yeah, they'll be like, well, you came here to tell us kind of thing.
Right. I want you to diagnose me blind. So you got to have a plan. Bottom line, you got to have a roadmap.
Yeah, 100%. No, it's true. Like the biggest one when I was studying my analysis of the market and stuff, they all just they're like, it's a cliche, but gotta have a plan or a goal.
No,
And I like every
you're right.
single book, and I'm like, ah, but actually doing it, I'm like, yeah, it makes sense. Like, if I want to make 1,000 this week off the market, when am I gonna have to wake up? When am I gonna go get in and out? What stops I'm gonna have to put in, kind of thing. So it's like, yeah, it's not the easy money. The reason I laughed earlier when you said if you're having fun, like investing and doing trading
It's
and stuff, you're
exciting.
not, it's exciting and stuff like that. You're doing it wrong. My father is like, he just keeps hitting buttons and he's like, this is so great. I'm like, you have no clue what you're doing, do you?
It's great
At all.
today.
It's
Might
great
be great
today, but
today.
yeah, and then usually like 3 weeks to a month later, he's like, why is it going down? The guy on Reddit said it was only going to go up.
There's this one of the people I really respect in the business. His name's Walter Deemer. He's
Mhm.
a legendary trader in the business. And I mean, all this is quotes. And
Mhm.
the book is titled "When the Time Comes to Buy, You Won't Want to." It's that's just one of the many quotes in this book. So, um, here's another one. Peter Brandt, who is a wonderful person. I have the pleasure of knowing him. But he said, when a trader starts to feel real smart, he or she is headed for a huge drawdown. And isn't that the truth?
It really is. Is there any place anyone like you want people to contact you or check out your stuff?
Yeah, sure. If you're interested in getting a hold of me, LinkedIn is the first and best place to go to get a hold of me personally. Connect with me there. The second would be libertaswealth.com. That's our financial advisory firm's website. So Libertas sounds exactly like it's spelled, Libertas, like liberty, but it's Latin. Stands for, or it means liberty, freedom, and independence in Latin. So libertaswealth.com. You can find me there if you want to shoot us a message or, anything. I always say you don't have to be a client to ask a question.
That's awesome though. Yeah, just the fact that people can reach out and be like, "Hey, I saw you on the show," kind of thing.
Yeah, for sure, man.
Thank you again for your time.
No, you're so welcome.
Have a wonderful day. Well, congratulations. You made it to the end. You are a awesome person. Not many make it here. So, being the awesome person that you are, can you do me one more awesome favor? Can you rate and review this on whatever podcast services you're using? If you do it on Apple and you leave an actual written review, I have a thing on my website. I will take your written review and post it for all to see. Congratulations, you're permanently sealed on my site. Otherwise, I am trying to do YouTube more and live streaming. I will try to put as many of the YouTube links in the description of the show as I can. So give your boy some extra help over on YouTube. Watch my videos. I just mute it and change the channel, change the window or something. But yeah, that's it. Thank you for being awesome and see you next time.